Afternoon, everybody. Welcome to Wendy Weekly. And today it's my absolute pleasure to be joined by Craig from Signature Financial Services. Hello, Craig.
Hi, everyone.
And Craig is a mortgage broker. So it's great to get somebody who's on the coal face, actually getting you those deals, finding you the money, finding you the right product for your investment purposes. So on today's Facebook Live, there's an opportunity for you to ask some questions of Craig. If you're looking to get finance for a project, or you're looking to start investing in HMOs, maybe you've got some questions that you'd just like to run past a mortgage broker. And Craig is very experienced in HMOs and knows a lot about what's happening in the market at the moment. So while we're waiting for people to come up with their questions and their comments and their queries, Craig, can you just tell us a little bit about yourself, about your background, how you sort of got into this?
Yeah, sure. Yeah. So, I mean, I took the sort of unorthodox approach nearly 4 years ago now of becoming a trainee mortgage advisor. I worked in IT before that, and I thought I would make a change, and then sort of gradually come to work for Signature. And then we gradually got sort of more specialised in terms of we do a lot of buy-to-let business, a lot of commercial business, a lot of limited company mortgages, HMOs and stuff like that. And I kind of just naturally fell into that. About a year ago, I became a director here at Signature, so I'm now one of the directors, and we've kind of gone from strength to strength really in this specialist market, which I think is, whilst the residential market, it's been really busy at the moment. I think if that does become turbulent as a business, we're probably sort of more 70% buy-to-let, specialist buy-to-let, than we are residential anyway, which I think has made us sort of quite recession-proof. So on my desk, my personal business is probably 90%, 95% even sort of buy-to-let, and a good proportion of that is HMO mortgages, remortgages, bridging finance to convert to HMOs and all that sort of thing.
Right.
Personally, I have a wife and two little girls, a 6-year-old and a 4-year-old. So I spend as much time as I can with them when we're not working. And we used to be able to go out and stuff as well, didn't we? But
it will come back. It will return, but we just have to be patient, don't we? The vaccination program is going very, very well. So fingers crossed it won't be long.
I know it seems a bit more positive, doesn't it, at the moment? It does. So, so I guess we're doing a lot of HMO stuff at the moment. So the market in terms of COVID, HMO, and lending in general. So when the first lockdown came, lots of lenders just paused lending, and obviously there was no valuers allowed to move and stuff like that. So the HMO market was particularly difficult for a couple of months because there was no products, there was no valuations being done. Lenders then came back with desktop valuations, but not on HMOs. Realistically, they'll never do a desktop on a HMO because they need to go and measure room sizes and all that sort of thing. So it was a while, and then they sort of come back at 60% loan to value. So they were very nervous of HMOs. The lending market was sort of third quarter of last year. By about the fourth quarter, they gradually come back, and I think we're probably back to where we were pre-COVID in terms of HMO mortgages and rates and stuff like that.
Right.
And I think in terms of clientele, it's as busy as it's ever been, really. So
right. So that's really good for your businesses. And by the way, in case anyone's wondering about the beautiful accent, it is, of course, a Stoke-on-Trent accent. You're literally just down the road from me, Craig, aren't you?
I am, yeah. I love it how you said a beautiful Stoke-on-Trent accent. I believe you.
Oh, it is. It's great. I absolutely love it. It's such a friendly and warm, accent. And that's because the people in Stoke-on-Trent are lovely and warm and friendly people. I've always thought that since I moved up here from the southeast, where people can be sometimes a little bit more standoffish. But Stoke-on-Trent, you've got lots of friendly people. So I love it. I really love it. I can't do it. The best I can do is, I know I'll work it. That's the furthest I've got. That's
okay.
Very good.
Oatcakes, what are your thoughts?
Say that again.
I said, what are your thoughts on oatcakes?
Oh, love them. Oh,
Okay, you're welcome then. You're in.
Oh, yes. Can't. I believe Robbie Williams gets them shipped into his house in California because he misses them so much.
Yeah, apparently so. I mean, I don't live too far away from where he grew up. In fact, my mum still lives even closer, to be honest. But yeah, the oatcake shop, I still go to that oatcake shop, and they're still as good as they ever were, to be fair.
Absolutely. So yeah, so we're based up in the Midlands. Your signature and we are, of course, as well. So just for anybody who's just joining us right now, just to say, if you've got any questions, mortgage product questions about HMO mortgages, please feel free to put them in the chat panel below the live today. If you're watching this after the live is finished, do feel free to put them in, because we can, of course, forward all your questions to Craig. He'll be able to answer your questions, even if you're watching this after the live has actually finished. So, Craig, thanks ever so much for giving us a bit of a backdrop to kind of last year. And I know that for some people it was a bit of a rocky time because of lending and because of COVID and the valuation problem and not being able to get surveyors out. So since, let's say, sort of December, January, what are you now seeing as happening in the lending market?
So it's still cautious, and self-employed people, so in general, are getting more questions. And of course, lots of people have taken out bounce back loans and government help and stuff like that. So that's causing us a few problems. So not to the fact if you've used it, if you've had a bounce back loan, for example, and used it genuinely to help your business, or you haven't used it and you've got it as a contingency, then that's absolutely fine. But we have had, a few clients that have used a bounce back loan for, an extension on the house and stuff like that, and lenders don't like it very much. So we're seeing the repercussions of the government help and government funding a little bit in that sense, in terms of lending, but it's got better. It's definitely got better. So still more cautious than they were, but not quite as bad in terms of client and the client shift. And I think I mentioned this to you a lot. We've seen a big increase in like supported living lease agreements and charities and registered providers and stuff in terms of like filling HMOs and that. The student market is back, and it's back as it was as well, because again, that was another one where if you got students in your HMOs, lenders were just going, oh, unis are Zoom and you're not going to fill it and stuff like that. So very positive, really. We used to have 80% loan to value HMOs. We're stuck at 75% on specialist buy to let, I'm afraid. But yeah, rates have gradually come down. Back end of last year, you're looking at over 4% for HMO. We're back to sort of 3.5%, potentially a little bit less on a 2-year fixed. So yeah,
there's some good products out there. The loan to value has come up again, which is very helpful.
Yeah.
What are you seeing in terms of revaluations and prices that valuers are giving HMOs that have been refurbished, and now maybe where somebody wants to recycle their money and get their money out? What kind of what's the level of risk that they're taking there in terms of revals?
It's difficult with valuations because obviously house prices, if you look at the house price index and stuff like that, they're still going up, but it's kind of the same as it's always been. You could send out 10 valuers to the same property and they'd all come back with different numbers. It frustrates the hell out of me, and I'm sure it does you guys a lot as well. So we're not seeing, to answer the question, we're not seeing any downturn or upturn. It's kind of the same as it ever was, really. There's no real pattern to it, so I'm not getting loads of down vals, and I'm not getting loads of up vals either. It's just where it was in terms of valuations.
Somebody's made a really nice comment, by the way, Craig. I don't know if you can see it. I can't see who's written this because we're on StreamYard, so I can't see who's written it. But somebody said, Craig and his team are brilliant. I highly recommend them.
So
that's nice to know, isn't it?
Yeah, definitely. Good
recommendation there. So in terms of, let's talk about sort of time scales, because one of the things that I know a lot of my clients complain about is the time it takes. I've got a client at the moment, and it's taken her about 12 weeks to get the finance for her latest HMO purchase. She had the deposit already, she's got the money for the refurb, but she couldn't get the actual purchase over the line quickly because it was the finance that was holding it up. So could you give some advice to people, first of all, to give them an expectation about how long it might take? And secondly, what can people do to be more prepared? And is there any way of speeding up that process?
with my clients, with you guys and whatever, I'll always be completely honest with you. It's worse than it's ever been for timescales. And there's a couple of reasons for that. So I know.
What we needed to hear.
And I know I am a salesman first and foremost, but I don't tell.
If you're honest, you're an honest salesman.
I'm an honest salesman, yeah. But no, there's a couple of reasons for that. So obviously, companies are working differently in terms of, people working from home and stuff. We are kind of still in a lockdown. So these big companies, big, massive corporate companies can't seem to adapt as well as sort of smaller companies like we have and stuff like that. That's one reason. But the biggest reason is solicitors and the stamp duty holiday, really. So they're inundated. So we're getting mortgage offers in the same sort of timescales within reason as we always have done. So we get your mortgage offer between sort of 2 and 5 weeks, and it goes over to the solicitors and it just sits there. And obviously we always chase the solicitors. We'll chase them on a weekly basis, and the issues they're having is they've got that much business because people are trying to push everything and get everything through before the end of March, the stamp duty holiday. But then that's give a backlog for any searches that need to be done and stuff like that. So I suspect your friend has probably had to wait longer than ever for searches, because depending on the council, some searches, I did one up Manchester way, and it went in end of October. Again, mortgage had offered sort of middle of November. The searches, it hasn't completed yet. This is a HMO, and the searches have come back this week. So that's like the local authority searches and stuff like that. And of course, with mortgage lenders, they won't like use indemnities and stuff like that. They'll want the full searches. So we're still doing lots of bridging finance, and we're picking up bridging finance now where clients are going, I'm going to bridge it because I'll save so much on stamp duty by bridging it, and then I'll refinance it after. It sort of works out less than the bridging.
And bridging finance, are they okay with indemnities?
Yeah.
Indemnities? Yeah, cool. We did a deal a couple of years ago with a repossession, and I had to get it over the line quickly. We used bridging, and because we had to complete the sale very, very quickly, we used a search indemnify policy, and it was fine. It worked absolutely fine. So, right, okay, good. So what's happening about bridging finance then? Are you seeing any changes to rates or loan to values, or is that still as active as ever, Craig?
Yeah, it's back. So again, it stopped, it paused. Loan to values were 60%. Cautious, heavy refurbs had stopped with lots of bridging lenders and stuff like that. But no, I'd say we're pretty much fully back. Rates again where they were before, and there's a decent appetite for bridging at the moment, so we're doing a lot of it. Like I say, we're doing a lot for the stamp duty holiday, and we're doing the same as we've always done a lot of it. We're doing the same as we always have done, where clients are buying a residential property, converting it into a HMO, we're refinancing the back end to get the money back. That's kind of our bread and butter, that is, so lots of our clients do that. They buy a house at auction or that's run down, that's probably unmortgageable. They'll spend 10, 20,000 on it. They'll do it up. We'll refinance it at 75% a few months later, and they'll go again, So that tends to be a lot of my clients. But yeah, it slowed down briefly, but it kind of came back in with everything else, and it's good. Fine now.
Yeah, that's really good. And so in terms of this timescale, so partly putting it down to the backlog that councils are sort of having to deal with searches, and you're also saying that the stamp duty holiday has encouraged more people to buy property, which I think is absolutely true. Do you think that Rishi is going to extend the stamp duty holiday? That is the golden question, and we all want to know. We're going to put some bets on this later.
Shall I stay on the fence? No, I think he has to do something. I suspect it'll be. I don't. To answer the question, I don't think he'll do a stamp duty extension, but I think he'll do something with the applications that are already in. I think that's probably the way they'll go. Hence why there hasn't been an announcement yet, because you can sort of say, well, if you had your memorandum of sale before February or something, we'll honour it for the stamp duty. So I think it's more likely to be a sort of a softer exit than it is, rather than an extension. But who knows? I mean, the problem is with an extension is if they extend it to June, that's great, and it still boosts the economy and stuff, and it's great for us. And I hope they do extend it. You've got the same problem in June, though, haven't you? You've got it. You've got to end it at some point, haven't you? So I suspect there'll be sort of an in-between, an interim period for clients that are already buying properties. And I hope, because imagine buying a house on the 1st of April and paying the stamp duty. Like,
I know. And I think this is the challenge, isn't it? Is that when you end these government programs very suddenly, people's behaviour changes very suddenly as well.
Yeah.
So rather than, what they don't want to see is a sort of sudden collapse in the housing market as a result of stamp duty suddenly being reintroduced. Mm-hmm. So whether there might be a gradual step up or there might be another form of stamp duty, I mean, we've just got to wait, haven't we? We've got about another month till the budget, and I think there's going to be a few announcements then that we really have to be, on the ball and looking for. But that's obviously one of them. That's a key one to do with stamp duty.
And I think from a business perspective, obviously, we'd love it to be extended. In fact, get rid of stamp duty altogether. But
Absolutely. That's what we want, Rishi. Get rid of stamp
duty. Get rid of it forever. But no, in terms of like clients, and we have been since the start of the year, to be honest, new clients coming to us making purchases, we're preparing them. I mean, stamp duty isn't, tax advice isn't part of my job, but I'm saying to clients, be prepared that you may have to pay stamp duty, because if you go onto the government website, they're reverting back to how stamp duty was, so you can still do the stamp duty calculator and stuff like that. So that's the only guidance we've got on it at the moment. So yeah, if anyone's buying a property now, I would make sure they had the funds for the stamp duty. Yes. Fingers crossed something happens, but it might not do. So
let's assume that there's going to be some taper, or it might just suddenly end. Either of those would obviously bring the current stamp duty sort of phase to an end. Hopefully then councils will start to catch up with paperwork. Hopefully then there won't be so many delays. But is there anything that a buyer can do to help themselves? Because it feels to me like I want to be able to say to people, look, if you do this, it doesn't necessarily, it doesn't mean that you're necessarily going to have a much faster process, but there must be some things that buyers can do, or things that you see all the time that people aren't as prepared as they could be. So what can people do if they're looking to apply for a mortgage, or they're thinking about buying an HMO? How can they prepare themselves for the headache of having to get a mortgage?
It's documents is probably the biggest thing, really. So lots of investors and lots of sort of clients who are brilliant at finding a deal. They know exactly what to do. But when it comes to sort of the paperwork end, and that's what we're here for ultimately. It's like I'm asking for documents and they're coming in and sort of drips and drabs and stuff like that. I mean, lenders don't ask for lots, and once we've got it, we ask for everything up front. And if a client gives us that, generally we don't have to go back to them. So we can get all the documents uploaded. The lenders will underwrite it once rather, because they'll have everything they've got, So things like that will speed it up, being more organised. But that, I guess that's easier said than done, depending on your project. Solicitor wise, we have a solicitor that's pretty quick that we recommend. But of course, people have their own solicitors and their own people and stuff like that. So it's a difficult question, really. What can they do to speed it up?
So when you say documents, let's be clear, what documents are you expecting people to be able to provide? And also, are there documents that you've regularly seen people wish that they had spent some time on before, because you asked them for them? Maybe it's a business plan or something, and they suddenly go, oh, I could have been writing this. So are there things like that you could advise people to kind of be preparing now?
Yeah, so that's a good question, actually. So it sort of sticks out like a sore thumb, the dreaded tax return and the tax year overview and stuff like that. So obviously I can use that for quite a long time. But most people pay their tax in January. They leave it till the very end of January. So like if I'm using 2019 and 2020 tax return, tax comp documents now, that's fine. I can use them until about sort of September, October, November, depending on the lender. But most people don't do them till January, so there's sort of a 2-month window where you need to do your tax return. So things like that, if you are preparing a purchase or you are preparing a mortgage, perhaps don't leave your tax return till the last minute. I know that means paying the tax bill quicker, and I do a tax return myself and leave it till the last minute, to be honest. But it's just one of them. That's probably one of the biggest things. So certainly like back end of every single year, it's like, I need your latest tax return. I haven't done it yet. It's with the accountant. Chase the accountant, get it done. Do you know what I mean? So that always costs clients a few weeks. I mean, don't get me wrong, if you've got nothing going on, you will leave your tax bill till as late as possible, like I say, like we all do. But if you are planning purchases and stuff like that, so yeah, the tax return's a big one. So we're asking for standard mortgage documents. So if you're employed, pay slips. If you're not, it'll be, it's called a tax computation and a tax year overview, which is like the other end of your tax return. So we need like sort of last 2 years of that, and then everything else you'll have your passport, your driving license, latest 3 months bank statements and stuff like that. So yeah, that's one thing. The searches, in terms of, like I said, the searches are taking a while, but this is always sort of a bit of a, so you can apply for the searches as soon as you buy the house if you want, but equally you're going to have to give the solicitor a few £100 then. So from my advice to clients, I'm like, well, really, you should wait till you get the mortgage offer, but you will have lost 3 or 4 weeks then before applying for the searches. But you could lose a couple £100 if if I'm not going to be able to get your mortgage offer. Now, I'm pretty confident on what I do. So most of my clients who I've seen several times and stuff like that, I'll go apply for the searches. Now, you bought the house, I'll get your mortgage. I know what I'm doing. You know I know what I'm doing. Let's apply for the mortgage. So that's another one. But sort of standard protocol would be, let me do my bit. Let's get the documents. Let's get it underwritten. Here's your legally binding mortgage offer off the lender. Now go to the solicitors and apply for your searches and stuff like that. But let's say you've lost 3 or 4 weeks at that end, really. So it depends how confident you are in your broker and your finance and stuff like that. So lots of our clients will go straight in when they buy when they have the offer accepted. They'll instruct the solicitor day one. They'll give them some money and we'll crack on. So that can speed up the process. Okay, it's not all like 12. I know I was like brutally honest earlier on, but it's not a 12 week process for every application. It really isn't. We are still getting them through in sort of 6-7 weeks, bridging finance even quicker. So it just generally as a whole has slowed down a little bit since the good old COVID days.
Okay, that's interesting to know. And do you still see lots of demand for HMO finance? Is that still a big part of what you're doing in your business?
Absolutely, yeah. I mean, in terms of, like I say, I do in Signature, we do a hell of a lot of buy-to-let stuff, and I'd say probably a quarter of that's HMOs at the moment.
Interesting. Yeah, interesting. So there's still good demand there. People are still filling their rooms, still thinking the market's buoyant. And I suppose they're, as you say, they're now maybe branching out to work in different sectors. So perhaps it was professional and students, but you're seeing now more of the charity sector, which is interesting.
Yeah, absolutely, yeah. I mean, we sort of, so in terms of like the registered providers, the charities, the vulnerable tenants and stuff like that, it's quite niche from a lending perspective. And we kind of recognised that a couple of years ago, and we sort of did a bit of work on it, and it was just, Together Money doing it at 7%, and people were putting the phone down on me, so we kind of put a lot of work into the area. So I think we're one of the leading brokers for that, really. So we get at least one inquiry a day now for sort of supported living lease agreements and that. And what clients are doing, and it's a good model, but it's a niche market. So we still only have sort of 3 or 4 lenders, but at nice sort of limited company rates and stuff, not 7%, starting from like sort of 3.5%, which you're kind of used to paying if you're a portfolio landlord, limited company or HMO landlord. And the model is a lease agreement from a supported living provider. Generally, it'll be a 5-year lease agreement. It would probably be a bit less than you would get for a private HMO, but you don't have the bills, and it's guaranteed rent. So whether there's anyone in there or not, the charity are paying you the rent. So it's kind of a hands-off investment. So that's why people are liking it. And I guess, there has been more difficulty in filling HMOs, no doubt about it. We haven't done too badly in Stoke, and I do quite a lot in Derby as well, and that's been pretty good. But I guess, the country as a whole, there are less people with COVID who want to share houses, I suppose, naturally, from the professional market and from the student market. There is less people actually going to university and stuff and staying at home. So that has had to have an effect on the HMO market. And I think that's why we're seeing this switch to supported living and stuff like that.
So it's good that there are some products there, because I know a few years ago it was very hard to get a product where a lender would lend against, somebody who was working with a charity or supported living. Like you say, it was just Together Finance at 7%, and you're not going to have many people taking you up on that offer. No. I mean, I also remember a while back that, high street banks like Lloyd's were offering commercial finance on HMOs. Can you still get commercial finance through high street banks, or is that really sort of disappeared now?
No, but it has to be generally. So I'll say, I mean, obviously, I get the question on a daily basis. I'm sure it is about a commercial valuation on a HMO, but it has to be big enough, really. And what I mean by that is up to sort of 6 beds. You want to do specialist buy-to-let. One, because the rates are nicer. You can have 75% loan to value. And it's a bricks and mortar val, but up to 6 beds, specialist buy-to-let, 75% interest only, and a decent rate. If you're going commercially, then it needs to be viable, because they're going to use your rental income as a commercial valuation. And I know out there people say you'll get 10, 12, 14 times rental income. You won't.
No.
We struggled before COVID with that, and since commercials come back very sort of cautiously, we're looking at sort of 8 times rental income. So you sort of 7, 8 beds, they can still go in the specialist buy-to-let world, but that's kind of the grey area where it doesn't quite fit with either. But then as it starts to get bigger, I've got a 20-bed HMO on my desk at the moment, which is commercial all day long, So it just depends on the project. But commercially, you're going to get a commercial val, great. You're going to get 65% loan to value. Your rate's going to be closer to sort of 5%. And it's going to be capital and repayment. Now, to answer your question about the likes of, did you say Lloyd's or TSB?
Lloyd's, yeah.
The high street, the actual nice commercial lenders, if you want me to put it like that, they want sort of 50% in. So you can still get, a commercial val at about, 4%, a nice rate, but you're looking at like 50% loan to value. And most of my clients, that just doesn't work for them, leaving that much money tied up, to be honest.
Yeah. And so it sounds like there's a sort of almost a matrix, isn't there, of how big is your HMO? How did it start off, and what have you done to convert it? What is it now? Does it meet specialist buy-to-let lender criteria? Would it be better doing commercial? And that's your job as the mortgage broker, really, isn't it, Craig, to figure out what is the project, what's the asset that we're borrowing against, and to find the right product and the right lender that will happily lend it to that borrower, because also you're looking at the risk and the experience of the borrower, aren't you?
Yeah, you're absolutely spot on. It is kind of, and it is my job. And don't get me wrong, we do nice, simple residential mortgages if anyone wants one of them too. But
would that make your day? Would you go, residential?
We do about one a month. No, as a company, we do plenty of them as well. But yeah, this it's more interesting for me as a person. That's why I like it. And it's. You have to think about it though. It's much more of a holistic view, so it's not like, oh, he's the best product. It's like, well, what, like you say, what are you going to do with it? Are you keeping it the same? What's your rental income going to be? And sometimes, I might be saying to a client, like I say, on a sort of 7-bed HMO, well, you can do specialist buy-to-let on this and this, or you can do commercial on this. You're netting the same amount of money, but you pay more for it commercially, because I know there'll be people watching now, and there always is, and a lot of the sort of the property training courses and stuff like that. It's like get a commercial val and stuff like that. But it's not always the way to go, because, like I say, and lots of people want interest only, so they cash flow better. And like I say, commercially, most of them want capital repayment now, unless you're leaving a big chunk of money, and that. For you guys building portfolios, it's counterproductive to leave 50% equity in a property, isn't it?
Yeah, that's a really good point. I think it's all about it's what I call the seesaw balance of risk and return. And if you're going to, pull out as much money as you can, and I would agree with you that I tend to say to people, work on a 7 or 8 times multiplier. Don't expect 10 or 12. That's just not realistic. So when it comes to, the final valuation, look at 7 or 8, and then there's still costs to come off of that as well before you get your actual valuation upon which the offer is then made. And, you might be offered 70%, you might be offered 75%. So it's really trying to tread cautiously, I think. So you don't kind of have this massive expectation that you can get all your money out first time round and extra and go again. Some people can, and I suppose at different parts of the country, and if you've got a really good deal, if you bought it for a good price, you can add enough value to be able to take that money out. But I think I say to people, look, expect to leave in about 10%, because if you believe you can leave in about 10% of the overall project cost, that's probably about where you'll be. But I mean, Craig, I might be getting that totally wrong. Do you think that's
exactly the page there? Yeah, I mean, those deals, like I say, we see them occasionally, but those deals where you get all your money back out and some, they're few and far between. But yeah, you've took the words out of my mouth. I'll say to clients, I'll say, well, if you bought that fully refurbished, if I said, for 200 grand, you can buy a fully refurbished HMO, but you've got to put 10% in, you'd be snapping your hand off, wouldn't you? And like, yeah. And yeah, I think that's realistic. If you're building your portfolio with a 10% deposit, by the time it's all done and you've got all your money back out, that's a good model, that, isn't it?
Absolutely, it is. And I also say that, it's very investable. You could find a joint venture partner, somebody who, if they can see that you can do that, you can find somebody who will be very happy to work with you, create a limited company, and you can then grow that model more if you run out of your own finance. So I think finding that model, making that model work, is really the key. But obviously having a good mortgage broker in your team is part of that power team that can make it happen. And one of the things that you'll be doing, Craig, is of course assessing the individuals who come to you, and if they're new investors, or if they're experienced investors, of course that all goes into the pot, doesn't it, in terms of how you assess them? Yeah,
exactly. Yeah, and HMOs. There isn't, and I guess some of you guys out there will know, there isn't many lenders that don't require you to have some lettings experience. There's Kent Reliance have been sort of a leader for letting you go straight in at HMO. But if you've got a year or two of buy-to-let experience, if you started off like that, where lots of people do, you'll be fine. But you can go straight in at HMO, but you're just limited with lenders. And there's little few more hoops to jump through and stuff like that.
And again, that's something that we tend to say to people, is it's possible to go straight into HMO, but if you can get a couple of buy-to-lets under your belt, it just means that you tick that experience box on the form, and lenders are much more likely to want to lend to you.
Yeah, and it kind of makes sense, doesn't it, from a lending perspective, because it's like there's a bit more. I mean, it does frustrate me because I'm like, well, they're not going to manage it themselves. So it's like, what difference is it? What difference is it if you have a letting agent for a buy-to-let or for a HMO? If you're managing it yourself, I get that then, because it's more difficult to manage than a single let, isn't it? But if someone else is managing it for you, I'm almost like, well, they've got the experience, but yeah, I'm tied by the same criteria as every other broker ultimately. And whilst they're doing a lot of this business gives me not any extra power, but gives me a few more contacts and stuff. I can come on, this and stuff like that. We can bend the criteria fractionally. I'm still bound by the same frustrations of every other broker, unfortunately.
Yes, absolutely. So are there any really good products that have come out recently that you're thinking, oh, this is a really good one? Or is it a case of things, perhaps not anything particularly new at the moment, but just a good range of different ones that if people came to you, you'd be able to kind of advise them which is best for them? Or is there one that stands out for you right now?
Not really. No, it's probably more sort of, I guess, positive that it's got back to where it was. So in terms of whether we're talking HMO or whether we're talking, limited company buy-to-lets and stuff like that, we've always done buy-to-lets. We used to do lots of personal name buy-to-lets, lots of personal name HMOs. There's been a massive shift in the market with obviously the tax changes and stuff like that for limited companies. So 2 or 3 years ago, I would have done sort of 1 in 5 limited company buy-to-let application, HMO or non-HMO. Now it's easily 4 out of 5, if not 5 out of 5. So a massive shift in that. Now, a limited company mortgage versus a buy-to-let mortgage, whether HMO or not, is generally sort of a percentage more as a rough guide. Now, before COVID, that seemed to be coming in, so and we seem to have got back to there a little bit. So hopefully, as that gets more buoyant and more popular, which it is, it's a massive growing market, it'll start to get more competitive. But we have a limited company standard let mortgage starting at sort of 2.89% now, which is pretty reasonable. HMO mortgage, let me multitask so I'm not telling the wrong thing. We have, I know there's a 5-year fix now for 3.5%. We're doing a lot of 5-year business because well, realistically, 2 years comes around very quickly. No one
It
knows when.
does. And these days, of course, just trying to get a new product can be quite hair-raising and quite time-consuming. It used to be that you just sort of pressed a button on a form and it would all be processed and you pay your fee and that would be it. And nowadays, it's much more complicated. So you're right, particularly because interest rates are set to stay low for a very long time, I think people want to lock it in. They know what their payment's going to be. They've got certainty then, and then they can get on with their lives and build their business.
Yeah, absolutely. And like I say, in terms of for HMO mortgages, you're using specialist buy-to-let lenders anyway. So it's sort of you're gonna have your legal fees again, you're gonna have your broker fees again, you're gonna have your valuation fees again, because there's no guarantee that these sort of Precise and Kent Reliance and stuff like that, they don't have to do product transfers. It's not like a regulated mortgage with HSBC where they'll always offer you a new product. They don't have to. So then you might have to fully remortgage it in 2 years. And yeah, from my perspective, a 2-year fix gives me repeat business every 2 years, but I'm more about sort of long-term portfolios and long-term business anyway. So yeah, 5 years, get fixed, get all your fees paid once, and then see where the market is in 5 years' time, rather than coming back to me in 2 years and saying, well, it hasn't gone up much, but you've got to pay all these fees again. And actually, because there's another booking fee, you might have to put a little bit in and stuff like that. You're going to be, well, miffed with me, aren't you, to say the least? So
absolutely. No, that's a good piece of advice there, Craig. Thank you. We've got a question come in about serviced accommodation mortgages,
okay.
which is very interesting because, of course, the serviced accommodation sector has had a very, very tough year with lockdown. Obviously, some sectors have been okay. Some specialist serviced accommodation that have been offering long-term or medium-term rent to contractors. Some of them have been fine, but of course, in the hospitality industry, we've seen practically a collapse in the SA market. So, question really about serviced accommodation mortgages. What's out there, and what are the high-level criteria?
Okay, so again, they're back as well. And like I say, had a tough time where no one was doing them. So serviced accommodation and holiday lets. I'll talk about both of them because it's very similar in the sense of your serviced accommodation is only serviced accommodation because it's not by the sea, basically. So it's like what defines serviced accommodation and a holiday let. So in terms of lending, we can do both. And yeah, genuinely believe that, as well, as crazy as if your holiday lets in Wolverhampton, it's serviced accommodation. If your holiday lets in Norfolk, it's a holiday let, and it's kind of the same model. So mortgage wise, we're about 4% on, well, not us, but lenders are at about sort of 4%. Loan to values, you can go up to 75. I'd say probably try and work your numbers out on 70% loan to value for serviced accommodation and holiday lets. But in terms of criteria, if it depends what the project is again. So we can do it commercially. If you're wanting a commercial value on a holiday let, then it needs to be an existing holiday let, because you can't be like, well, it's going to do this much per year and so on and so forth. You can't predict that. So bricks and mortar's fine. Purchases of holiday lets and stuff are fine, and they will sometimes write to a local agent and ask the agent for their opinion on the low, medium to high value in terms of what you can get as a holiday let and what you can get as serviced accommodation. But in terms of mortgages, no, it's fine.
Great. Well, that's a really positive piece of news, because when the SA market was sort of booming a few years ago and lots of people getting into it because of the tax advantages, that was one of the problems, was that quite a lot of people were using the wrong product against that property. Yeah. And I think then lenders started to realise, oh, hang on, there's a new phase in the property investment world, which is called this thing called serviced accommodation, which, you're right, is a sort of variant of holiday lets. We better start producing lending against these buildings, which I think there had been, but really more for sort of bed and breakfast and hotel type accommodation. Yeah. Whereas a lot of these providers now are, yes, they are doing Airbnb, they are doing booking.com, but a lot of them are also doing direct services to contractors, to workers who just want short-term lets. They don't want the hassle of moving in to a single rental property where they have to deal with the bills, and they're not really in an area long enough to want to rent an HMO room. So SA works very well where you've got that kind of market.
Yeah.
But in the past, it's been quite difficult to get lending. So that's really good news. You don't see any problems with that, Craig, clearly.
No, and I'll tell you when they work sort of really well is if so there's lots of lenders that will do. So obviously we talked about, you know, what sort of rates you should get and stuff like that, and trying to like push the valuation, which is always a thing. But if that property works as a single let, then they absolutely fly. So there's a few lenders that will do serviced accommodation, holiday lets, various different names they call it. But if it stacks up on it as a normal single let anyway, so for example, you know, if you 200 grand home could rent out as a buy to let for sort of 800 quid a month in its own right, they absolutely fly. They do, Wendy, to be honest, because you can just assess them in that way, but put them on the correct product. So and that gives the lender reassurance then, because of course, you know, if you're going for this, you know, big serviced accommodation and stuff, and it's the first one you've done and it all goes wrong, they know it's still fine as a rental property, you see. So again, it kind of makes sense. There's different projects, of course, you know, it depends how big it is again and how sort of quirky it is in your own experience and stuff like that. But yeah, it's very much, it was the word on the street, wasn't it, service accommodation. It was growing at a rate of knots, and obviously you're right, COVID's, because you get a lot of people who come into the country and stuff like that who haven't been able to travel and stuff. So it has had a knock, anti this year or last year.
And maybe now, you know, some of the changes, well, hopefully lockdown will slowly ease by March. Certainly, I'd like my son to be going back to school by then. Homeschooling takes its toll after a while. But you know, obviously for him as well, to see his friends and be back in the classroom would be probably better for him. So I think that everybody is kind of now thinking, oh, when can, you know, how long have we got to wait until lockdown can be lifted? And I think then people will start to travel more. You know, there's going to be people who are going to want to go on short breaks. And hopefully, of course, the economy will start to move again, and we'll start to see a little bit more movement in the economy and people needing short-term places to stay. So I think the SA market will come back, but I think it will come back in fits and starts, because, you know, lots of people will have lost so much money over the last year, which is awful.
Yeah, I 100% agree with you though in terms of growth. I think holiday lets and SA market is going to be bigger than ever for the next couple of years, because I think people, you know, getting on a plane is going to be difficult, isn't it? So people are going to want to go, you know, holiday lets and service accommodation and go for weekends away, and they're going to, holiday making is going to be in this country a little bit more, whether that's service accommodation and I know service accommodation is not just for, you know, a city centre break and stuff like that. You get like lots of workers and stuff like that. But I think you're absolutely right. I think people are going to be travelling and staying in the UK a lot more than ever for the next year or two. So I do think it's a growth area. I hope it is.
Absolutely. Something to look forward to, isn't it? The
Yeah.
idea of going on holiday. Oh.
No.
I miss that. We've got a few thoughts about this year, possible holiday destinations. So you know, keep your eyes peeled. I'll reveal all at another time.
Okay, sounds good. Will do.
Great. Well, listen, Craig, thank you so much for your time today. It's been really, really good to have you on. You've answered some brilliant questions, and I think really it just remains to say, if anyone would like to get in touch with you, once we've finished the interview, please feel free, Craig, to put your contact details in the chat panel below the video. Okay. I think one of your team has already put something in there, which is really good. Thank you to everyone who's joined in and sent in questions for today. And yeah, please do get in touch with Signature, who can help you with all your lending requirements. And thank you very much to you for your time today on the Wendy Weekly. And really appreciate having you.
Thanks for having me. Brilliant. Thank you.
Thanks very much. Bye for now.
Bye.